Welcome to the ILRAA's first ever financial literacy series. My name is Michael Seitz. I'm ILR class of 2022 and now based in Manhattan. This series aims to equip ILR professionals with the personal finance knowledge to build practical day-to-day budgeting skills and meet savings goals. So tonight, our session will cover budgeting, savings, basic insurance, and asset classes like stocks and bonds as well. To help us navigate the nuances of personal finance, of course, we have two fantastic ILR alums who are financial advisors leading the conversation. But before we meet our esteemed ILR alums, a quick plug for the ILR Alumni Association. So upon your graduation from the ILR school, you are automatically welcomed into the fold of the ILRAA. This is a group of committed volunteers who dedicated their time and expertise to providing lifelong support to ILRs and to connecting ILR's 17,000, yes, 17,000, I said, amazingly diverse alumni to each other, the school, students, and faculty. Please feel free to contact ILRAA President Nicole Mormillo to learn more and get involved, including in our local chapters and affinity groups. Nicole Mormillo will put her email in the chat so you can reach out to her. So without further ado, let me get on to our speaker introductions. First, we have Michelle Hansen with us tonight. Good evening, Michelle. Michelle graduated from the ILR school in 2011 and from the New York Law School in 2014. She stayed in New York, where she lives in Battery Park with her husband and their daughter. Michelle has been a wealth management advisor at Merrill since 2014, focusing on anticipating both the expected and the unexpected in her clients' lives. Due to her educational background, Michelle's practice always includes extensive tax and estate planning discussions. Thank you so much for being with us tonight, Michelle.
My pleasure.
And next up, we have Stephanie Vitti. Stephanie graduated from ILR at Cornell University in 2009. She began her career at Morgan Stanley as a fixed income specialist. And in 2016, she received her Certified Financial Planner, that is a CFP designation, and joined HLS Wealth Management. Stephanie works with individuals and families to help them navigate all aspects of wealth management, and she currently lives in New York City with her husband and two young children. Welcome, Stephanie.
My pleasure. Hi, everybody.
And just before we get into the questions, quick note for the audience. If you have any questions along the way, please feel free to throw them in the Zoom chat, and we'll do our best to get to them on a rolling basis. But now I'm going to turn it over to our two esteemed alumni guest speakers tonight, and we'll get the show on the road. So first, let me start with you, Stephanie. Let's start in a high level, general budgeting standpoint. What is the right mix across spending, investing, saving, in terms of allocating portions of one's paycheck? Can we start there?
Sure. Guideline, this is like people like to talk about 50-20. So first pay goes towards the things you need, the 30 wants or discretionary spending, and then 20% is left over for savings. So that could be a good way to gauge if you're saving enough. And I'll use the words investing and savings kind of interchangeably. We'll talk, I think, in a minute about like what savings is, like traditional cash savings, and then I think Michelle's going to talk a little bit about investing a little bit later in the session. So 50, 30, 20, so 20% for savings.
Understood. And speaking along the theme of savings, an emergency fund, a professional, I always heard, keep an emergency fund, but what does that really look like?
This is a great question. This is really common, and it's really easy, I think, to get right. So I believe that everyone should have two bank accounts. So you should have a checking savings account. The checking account is going to be your operating account. So that's where your paycheck goes. That's where you're going to pay your bills out of. But you want to keep a very minimal amount in that account. Maybe you're keeping like 1 to 2 months worth of expenses, because the checking account that you have, checking accounts in general just usually don't pay a lot of interest, so they're not the place that you want to hold a lot of cash. The savings account, that's going to be your emergency fund. That's your cash reserve. And that should hold typically 3 to 6 months of expenses is the rule of thumb. So if your expenses are $5,000 a month, then maybe you have between $15,000 and $30,000 in the savings. If you are someone who's freelance, or you're a business owner, or you're somebody who works on commissions and your pay is kind of lumpy, then maybe you want 6 to 12 months as a cash reserve. If you think you're in danger of being laid off, you might want 12 months. The point is you want an amount that you're comfortable with. I always say to clients, like when you log into your bank account on the website, like what's the number you want to see? What's the number that's going to make you feel comfortable? And that's usually a good way to go. I would say it's also really important to be thoughtful about where you're holding your savings. So most people default to their bank, right? Like they have Chase checking, so they have their Chase savings, and that's where it all sits. But the problem with that is that a lot of the big banks, whether it's Chase, Citi, Wells, like all the kind of big commercial banks are paying very low, like minimal interest on their savings accounts. So what I would recommend is opening a high yield savings account and keeping your emergency fund cash reserve there. There's a lot of good options. You can honestly Google this, but Capital One is traditionally a good high yield savings account. Marcus, there's also American Express, FSB. All of those are going to have interest right now that pays between 4.3, 4.4% just on cash. So again, I would have your checking account, and you can hold that at any major bank, just like whatever one appeals to you. And then you would have the high yield savings account be where you hold your actual emergency cash reserve.
Thank you, Stephanie. Heard loud and clear. I think that's a great strategy to adopt for all of us in our daily lives, especially getting our paychecks and being a little bit more thoughtful about saving and investing those. But now turning to you, Michelle, taking this in maybe a more long-term point of view, can we talk, especially for folks who might be just starting their careers, or folks who might be changing jobs and joining new employers with different retirement plans? What is the difference between a traditional and a Roth IRA? I think those are terms that a lot of people hear, but definitely don't know the specific nuances or really what those plans entail.
Totally. So both in this scenario are IRAs, and the IRA stands for individual retirement account. So it's not something you get through your employer. These are accounts you open on your own. With a Roth, you're contributing after-tax dollars, meaning you make your income, the taxes happen, and you get to contribute that money to the account. Your money grows tax-free, and you can start withdrawals after currently age 59 and a half, no taxes owed. With a traditional IRA, you can contribute pre or after-tax dollars, and that's going to depend on your income. And your money grows tax deferred because your withdrawals get taxed as income after age 59 and a half. You can take after 59 and a half on a traditional. You must take at a certain age. Right now at 72, it will be 73, and they're planning to kind of raise it incrementally over the next few years. Those are required minimum distributions. They'll be taxed as income out of a traditional.
Understood. And also, I think in terms of different employers offering diverse options for retirement and savings, again, in a long-term lens, what about the difference between an IRA that you just described and a 401k?
So 401ks are offered through employers, and IRAs you open on your own. The contribution limits are very different. So you contribute to a 401k this year, the legal contribution limit is $22,500, different from your employer match or whatever. This is how much you may contribute. And you can contribute another $7,500 on top of that if you're over age 50. It's called a catch-up. IRA contributions are more limited for Roth and traditionals. They're this year capped at $6,500 a year with another $1,000 if you're over 50.
Got it, understood. And turning to Stephanie now for a second, talking about employer contributions in the context of 401ks. Should I contribute enough in my 401k to get the employer match, whatever the percentage match may be? And why should I, if so?
So yes, if you have a 401k and they are matching you, you really, really should contribute enough to get the match. So if it's 4% of your salary, you're doing 4% of your salary. It's free money. So at the minimum, yes, you should do that. Okay.
And then, should I be maximizing my contributions through work, up to the 22,500 that, Michelle was saying? Is that different for different people and various stages of their careers?
Yes, that is different for different people. So the question is, the maximum you could put in a 401k if you're under age 50 is 22,500. So do you try to do the full 22,500? So obviously that's a great goal. If you can do that, go right ahead. But I always try to remind people that you cannot touch your 401k money until you're age 59 and a half. And so I have seen this a few times in my career where people are so great about saving to their 401k because it's coming out of your paycheck. You don't really see it. And so they end up with like tons of money in their 401k, which is awesome. But then they have very little money in their just like regular investment account. And so that can be a bit of an issue when you want to buy a house, or, you know, one of your kids is going to private school or something like that, and you want money. You can't dip into your 401k for those reasons without penalty. So it's important to have a balance. If you're in your 20s and 30s, it can be really hard to like max out that full 22,500. I'm fine with someone doing like a smaller amount to the 401k in favor of saving that, you know, the rest of their money to like a regular investment account that they can dip into that can be used for anything in the future.
Understood. Thank you. And just along the lines of, you know, talking about folks in their 20s and 30s, no secret that a lot of the attendees this evening are younger alums, recent grads, and also, you know, folks with the increased price, as we all know, of college tuition at Cornell and at ILR. For people with student loans, how should one prioritize paying down debt versus saving for longer term retirement, Stephanie?
Really common question. So I think first, you know, if you have student loans and you're working at a job that happens to have a 401k with a match, I think you should obviously, you know, you want to pay the minimum that you have to pay on your student loans, and you also want to try to get the full 401k match. So like those two things should hopefully be happening, and that's the bar. And so then the question is, okay, I've done that. I have this extra 5,000 or 10,000 that I've been able to save. Like, where does that go? Am I paying that towards my loan, or am I investing it? And so the answer I'd give someone is really based on what's the interest rate on your student loan. So if your rate is like in the 2%, 3%, even 4% range, I would pay the minimum on your loan and I would take those extra funds and invest it, because in that case, you're investing because hopefully the return on your investment, like if you own stocks, for example, should be higher than 2 or 3 or 4% over the long term. If your loan is like 6%, 7% plus, then I'm probably more in favor of you should pay down that loan, because that's a higher hurdle for you to beat with any investment. And so that's sort of like the rule of thumb that I would use. I think there's a psychological component to this. Like, I think generally people want to pay down their debt. They want that slate wiped clean. I think that's a good thing. And if it's going to like truly make you feel better to wipe out the debt, then I can get on board with you doing that first. But generally speaking, I'd much rather somebody with like a 3% student loan pay just the minimum, and then they're investing the rest of their money.
Perfect segue, Stephanie, to going to Michelle now, talking about investing money. Michelle, I'll put it to you very bluntly. How do I start investing?
Oh, the best day is always today. And I say that every day. Today is always the best day to start investing. And your first step is really easy. It's opening a brokerage account and determining how much money you want to start with. And to Stephanie's point earlier, this is one of those things you can totally Google. We all have our own opinions. We all have our preferred online vendor. If online makes sense for you, if you need a human being to get started with, like one of us, we exist all over the place. You'll figure out what's comfortable, but figure out the amount of savings, and certainly retirement money should be invested, but the amount of savings that you have available to also invest, and just pick a platform.
And Michelle, how would I then, let's say I followed I picked a platform and I'm looking now at different investment products, right? Could be somewhat overwhelming with all the different options in today's world, firms, different offerings, how much to invest in stocks versus bonds, for example, talking about asset class.
And we won't get into super granular detail today, but the younger you are, the more aggressive you can be, because you have that time ahead of you to kind of ride out the changes in the market. So the traditional rule of thumb has been to use either 100 or 120 and subtract your age from that number, 100 or 120, and the difference is your allocation to stocks. That's like a super old-fashioned standard way to do it that is a good jumping off point still. The remainder, so like for me, that would result in 85% in stocks if that's how I was doing things, and the remainder can be in bonds or something similar, if that makes sense. And it's important though, once you've kind of set that baseline, figure out how much the swings in the market will affect you. Like last year, the S&P 500, which is generally what we mean when we say the market, was down 19.4%. Most people don't love the idea of being down 19.4%, especially if you're just starting out with investing. That's a really bad feeling. Once you've been doing it for a while, you have a few like really great years and you go, oh, that's fine. Annualized, it totally works out. But that is not a great feeling all the time. So you want to know how much will that ride affect your stomach, and maybe it'll shift you more aggressive if you can handle that increased, risk reward exchange, or more conservative if you really can't handle watching volatility in your portfolio. So that's a good baseline though.
I'm going to jump in with a question from the
Of course,
audience.
Nicole. Go for it.
We got a question. How do you recommend choosing a qualified financial advisor? What certifications are important? What policies would you seek or avoid? For example, commissions or flat fees. So, as we're navigating this space, how do we pick the right person to help us?
Wow. Also something you could totally Google, so you don't have to just believe me. But there's a result that's like 10 questions to ask any financial advisor. That's a good one. Run with that, right? We all know about it. That Stephanie is excellent. That's considered like industry standard gold. There are a bunch of them. CHFC is one that I have. I have several. And there are different ones that are for different specialties. So if you're really interested in like impact investing or focusing on the social governance aspects of investments, you want somebody with a CSRIC, which is CSRIC. If you are really, really focused on divorce specialty, there's a specialty for that. If you're a member of a certain population, there are usually certifications that will specialize you in planning for those populations. So there's a lot of different things to look for. Personally, unofficially, not representing any of the firms here, I would say you're looking for somebody at a big house that like you trust, that has very good publicized standards and a lot of alternatives to you. You don't really want like some guy hanging out in a strip mall, like I definitely know what you need, guaranteed 12%. Don't do that one. But you're looking for somebody that you're comfortable with. So okay, start there.
Stephanie, if you want to jump in with any additional, feel free.
No, I think I think that, financial advisors, they kind of run the gamut. You can find someone who's just going to help you with your investing. And I would not recommend that. I think you want to find someone who's going to help you with investing, but then also the financial planning aspect, right? So finding someone who's a certified financial planner is always good. The bottom line is like you can find someone who could just do investing, or can also help you a little bit with like tax and thinking about insurance, and as you buy a house, like there's other stuff that's not just the investing part. So I would look for someone who can do all of that. And recommendations are great. If you have an accountant, you can ask them if they have a trusted person. If you know anybody who's an attorney, a lot of times attorneys will know good advisors. And there was, I think in the question it said, do you do commit? Like, I would avoid people who are paid on commission for sure. Those are people who are paid like by the product that they're selling you. I think someone like a fee, whether that's a flat fee, an hourly fee, is typically, I think, a better way to go than commission based.
Great, thanks. And we got another question. Do you recommend investing in a brokerage account before maxing a 401k to 22,500?
It depends.
So that's like what we were just like talking about. So the last time I did a webinar like this, I said the same thing, and people were writing and they're like, wait, what? I don't max out my 401k. I was like, always told you max out your 401k, or like you put money in the 401k. It's great to put money in your 401k. I hope that everyone is trying to do that. I'm saying if you only, let's say like $20,000 this year to save, and you're like in your 20s and 30s, I would not want to see like that full 20 go in your 401k. I would say maybe like 10 goes to the 401k and 10 goes to like a regular investment account, because the regular investment account is what you're going to use if something happens to your job, or you want to buy a house, or you need money. You're not going to go back to your 401k. You really can't do that. You're penalized and it's taxed. And so that's all I'm saying. Like, I hope everyone here can eventually max their 401k, but if you're trying to decide, don't forget about a regular investment account.
Agreed.
Okay, thanks for that. And audience, feel free to get those questions. Keep them coming in the Q&A chat. Really appreciate those too. And again, we'll get to them on a rolling basis. So thanks so much. Let's go back to Michelle. I think we were just talking about before the pop-up Q&A questions about stocks and bonds, correct? So also wondering, again, in terms of different investment products to deploy capital to invest in, hear a lot about ETFs, exchange traded funds, mutual funds, but don't know a lot about them. So can you kind of debunk these very fancy and attractive terms for us and give us a little more insight in terms of, what are we actually investing into?
Yes. So both ETFs and mutual funds are kind of collective investment products, like vehicles. So instead of looking at the stock market and saying, okay, I have $20,000, I'm going to buy this many shares of Disney, this many shares of Coke, this many shares of Visa, this many, and figure it out and allocate it, and then you're kind of stuck with that many shares of whatever. You can say, I really want to be exposed to biotech this year. I really want to get into green energy, whatever your thing is. And you can pick funds that are made up of baskets of those individual stocks in those areas, or maybe in certain strategies. Maybe you want large cap value. Maybe you want to kind of get into China a little bit, but you don't know how. Those are good ways to do it sort of more cost effectively. And the primary differences between them are how the holdings are made up and the internal fees. So mutual funds will generally have higher internal fees, generally, depending on their share class versus ETFs, which are one share class. Mutual funds are more likely to be actively managed portfolios within them. So that's where you're going to say, like, I want an aggressive portfolio. I want a large cap value portfolio. I want it to be doing X, Y, very specific, and it's a strategy. Whereas an ETF is usually tracking an index, like the S&P 500 is an index. And they trade differently is the other big difference. Mutual funds only trade at market close at 4 p.m. every day, and ETFs trade throughout the day, second by second, just like a stock. And that's why they're called exchange.
Understood. And just a quick follow-up question, Michelle, because I want to get to a couple of audience Q&As that we had pop up. But you mentioned the S&P 500, and you mentioned that there are numerous ETFs that are almost like kind of pegged to it and track it essentially, correct? So how should one think about, investing in those ETFs, at some major asset managers products? How do we differentiate one from another? Are they all pretty much the same? Should we look into the fee structure, as you said? Should we trust the name of the manager? I mean, what are those kind of factors for decision making for investors who see pretty similar ETFs across different managers?
It's a really good question. So we're focusing on ETFs for this one. Internal fees matter. They matter. You can find them. They're always on the Morningstar report for each one. And that's what'll pop up generally if you're looking for certain ETFs and you click fact sheet. It's going to be their fact sheet. It'll have the internal fee on it. They'll all be like less than 0.25%, if that, per year, taken out of the performance of the fund. That's reasonably negligible for the proportion of the investment that you're getting. So balance the fees with also the name brand. Name brand is kind of a good way to think of it. Recognizability, and also you're looking for liquidity. You want to see that this is a really broadly traded one. You want one of the big few, but also just to keep hammering at the S&P as a good example. There are a bunch probably, that trade the S&P 500 purely. It looks exactly like the S&P 500 proportionally. They have the exact same names and the exact same ratios, and that is how it trades. Great. There are a bunch also that are S&P 500 trackers, but instead of being weighted the same way the S&P is, where it's 500 names, and the names that move the most are the ones with the most representation, these are equal weighted. I like all 500 names, and I want to have all of them equally represented in my portfolio. Both are ETFs. Both are S&P 500 ETFs. One might make more sense at a different time than another. So also looking at that. But the big ones are like, don't be driven by cost internally, because they should all be reasonably low. Focus on your comfort level with the distributor, and also how it's made up and how available liquidity is.
Understood. Thanks for the nuance and on the follow-up question. Stephanie, let me turn to you. I want to go off script for an audience question. This is submitted from an anonymous attendee. This is, how much should I invest for my first time what is a good range? I mean, it's quite a broad question, so maybe we can narrow it down a little bit. Let's say, I mean, I'm looking today, the average annual salary in the US is about $60,000. Let's say, we got a pretty selective group over here being all Cornellians and ILR alums. Let's say, someone's in the range of $60,000 to $100,000 in income. Let's say, as per Michelle and Stephanie's advice before, they're contributing getting the employer match for their 401k. So they work at a company, and they have, let's say a couple, $1,000 in kind of disposable income, hopefully. How much if they, again, rookie to the investment market, the stock market, never invested in stocks or bonds in the past, what is a really good starting point for someone to really dip their toes in the water? It seems like that's the kind of background of the question. So Stephanie, if you wouldn't mind starting.
So like your hypothetical person. Okay, so let's just pretend that they have like they've spent all they're saving like their 20% or so. And some of it went to the 401k. I'm just gonna say someone has $10,000 left over, like let's just say 1,000 a month, right? Like 12,000 for the year, 1,000 a month. Like that is your kind of leftover amount that you have to spare, right? So if you have like $0 in an emergency fund, the first place you want to save is just to build up the emergency fund. So I would want to see that person have like the 3 to 6 months of expenses in the emergency fund. So let's say that's done. So now you have your emergency fund, like your cash reserve, you did the 401k match, and now you have this like extra 1,000 a month. I would say a few things. A, that 1,000 should be invested, not saved, meaning you don't want to just like save to cash forever. I've seen that. I've seen many people come in, they're like, I have 100 grand in cash just like sitting in the bank. I have 200, like people amass this amount of cash because they've never invested it, so it just like sits in a bank account. So you don't want to do that. You want to have your emergency fund, and then we're investing it. When you start investing, it doesn't have to be, because this person's question was like how much to invest. I would say like it doesn't have to be like a big event. It should not be like I've amassed all this cash and then today I am investing it. I would try to automate things. I love when people have it set up so like $200 a month goes in my investment account, right? Like I get paid, I pay all my bills, 200 goes from my checking into my investment account. And so then you're investing every month, and that's really nice because it's automatically happening. You don't really get too hung up on like what the market did today or like what the latest in like fiscal policy is. You're just kind of doing this every month. I would also say, kind of in regards to like the question about like what stocks do you pick and all that stuff, you can use like there are robo advisors out there. I like Betterment. I don't have any skin in that game. I just like I think the functionality of the website is good. And you can sign up. There's like a few questionnaires, questions that they'll ask you about like what's the money for, and that Betterment will pick the investments for you. You'll have your asset mix, and they're going to pick the investments for you. So you don't have to choose like what stock it is. You don't have to think too much about like what ETF it is. They're going to do it for you. Obviously, there's a fee associated with that, but it's a relatively small fee. And so I would consider setting something like that up, have it be automated. I hope that answered the question of like, how should I invest my first time? Start with $1,000. Start with something small and get comfortable with it, and just try to add to it like maybe monthly. I hope that answered that.
Very thoroughly. Thank you, Stephanie. And Michelle, just giving you a chance to also respond. Anything to add?
I think you nailed it. It's definitely a common thing that people show up with, either a ton of cash saying like, here we are, this is what I've done, or no framework kind of like this, where they just say, well, what's a good starting point? I don't know. I know people for whom like $20,000 is totally fine, right? But I'd say the only addition is try to make it an amount of money that like matters, but you can comfortably watch go down soon, and it will not ruin your life.
Great. Well, thank you both. Turning to a couple questions, and I know we have one in the chat from Catherine that I'm going to get to in a second, but first going to this one, which I think is also a neat segue from what we're just talking about. This question from Vernon. So let me answer this live right here. Assuming an investment time horizon of 3 to 5 years to fund education, travel, and home purchase goals, what asset allocation strategy would be recommended? And Michelle, maybe we'll start with you on this one.
Sure. Those are very different goals. 3 to 5 years is not a long time. Also in investment world, generally my rule is like once we're at 2 years out from a goal, that baby's going in treasuries and CDs. We're doing nothing exciting. 3 to 5 is like really close to 2. So again, if it's a significant amount of money where you're saying like, this is all of my money and it's a lot, and I want to make sure I have this much for this and this much for this and this much for this, break those goals up, break up your money by the amount of each goal that you think you're going to need to have. And then you can sort of look at timelines and say, okay, you can be a little more aggressive with the vacation money because that's a want, right? The education money, I really want to lock it down and do something extremely boring with it, which boring is really great right now. Boring is 5%. That's fantastic. We live in amazing times. And education and vacations, and what's the other one?
It's education, travel,
Home.
and purchases, home purchases.
Home purchase. Home
Like-
purchase, like again, super boring, unless like it's one of those tentative, I'm in the market, I'm vaguely looking, everything is terrible, I wish I kind of thing. Then sure, you can be a little more aggressive, but the allocation is going to be very specific to you.
Stephanie, anything to add?
I think that was great. I was nodding a lot because I think like same. If someone comes in, they're like, "This is my money and I'm buying a home with it in 2 years." Like we're holding cash for that. You're not like putting that in the market because the stock market could go down 50%. Like it's happened, right? So like you don't want that home purchase money to all of a sudden be half of what it was. So you hold cash the closer you get to a goal. But as Michelle was saying, that's why different accounts exist for different reasons. Your retirement accounts, 401k, IRA, all that stuff. That's the long-term money. That could be like 80% stocks, 100% stocks. If you're saving for education, it's somebody's college education, you're doing that through what's called a 529 account. That could also potentially be pretty long-term money if you have like young kids. And so that's why that's in its own separate account. So yeah, it's not like you're thinking of you shouldn't really think of like all your money as, in one account. You can divide it and do it based on time horizons, as Michelle said.
Loud and clear again. Thank you both for that. Let me turn to audience question in the chat. This is going in a different direction, so to speak, a little bit more late stage career professional. So if I am 7 years away from retirement, congrats, that's very exciting. How should I invest my money? Whom should I select to assist me in planning for retirement? I assume, we're thinking about certified financial planners, estate planners, maybe financial advisors, there are a whole host of different actors in the personal finance landscape. So, Stephanie, you can start with this one again. 7 years away from retirement, how should I invest my money? Who should I entrust to assist me in planning for retirement?
Well, if you're 7 years away from retirement, so I don't know your age, but let's assume you're around like you're in your maybe 50s, I would still be fairly I would have that person likely, 60% stocks, 70% stocks. I mean, I would still be fairly on the aggressive side. We all are living longer, so it's not so much planning for retirement as it is planning for a longer life. You kind of old school way of thinking was like, oh, you just, when you retire or close to retirement, you just buy a lot of bonds and you live off the income. That's what people would say. But bonds, other than this moment right now, bonds usually are going to just, be inflation, a growth engine. Like you really want your portfolio and your investments to grow over time, and growth happens from, the stock market traditionally. So I would have that person be, 60, maybe 70% in stock still. And who can help you with that? Yeah, I mean, that's like a certified financial planner. There's other designations that retirement planner type designations, but certainly someone who has that planning background.
And turning to you, Michelle, if anything to add, but how would one again seek that person out? Is it Google search? Google places near your area now. If of course, we're doing this panel via meet, virtually, we'll recommend then let you expand on the question at large.
Yeah, you can Google it, certainly. I would definitely mention it earlier. Ask people you work with, people you're friendly with, if they've successfully navigated this. Recommendations are always the best way because you'll get a person, instead of just a name. you can also reach out to either of us. I'm okay with it. I'm speaking for both of us now. Reach out to either of us. We'll help you find the right person. That's completely fine. We're all fellow ILRAs. And yeah, I think there are many, many ways. But an estate attorney, if you're working with one, you should have one by this point in your life. And that person probably has a few advisors that they work with, or your accountant, tax advisor should have somebody also.
Thank you both for the responses on that question. Thanks again to the audience member who submitted it. We have a couple more longer term retirement savings questions in the Q&A. So above a certain income level, is there still a way to take advantage of Roth IRA? For example, this question is coming from maybe someone with student loans. So any tips for navigating that? Michelle, do you want to start?
So what the question asker is alluding to is there is an income level after which you can no longer participate in Roth IRAs with all those magical tax benefits. You have to use traditional norms. So if you have an employer 401k, many, if not most employers at this point, certainly large employers definitely do, they offer a Roth portion of the 401k. That's one way to get Roth money in. Otherwise, there is, I'm deeply unhappy to talk about it right now. There is something called a Roth conversion. Google it, ask your tax advisor. It's probably a no, but it's an individual calculation for each person. The deal is you would put money into a traditional IRA, go in and then instruct your advisor to convert it into a Roth IRA, and you pay taxes, income taxes on additional income taxes on those dollars for that year. And it year by year, if you want to do it, $6,000 at a time, that's one thing. It's kind of annoying, but it's one thing. But then you get into, well, I have a large amount of money in traditional dollars, is now a good time to convert. And unless you're having like an artificially low income year, or it's the first year out of retirement and your balance of your retirement account is not stupendous, it doesn't usually make sense.
Okay, well, I'll pose this next one to you then, Stephanie. If your employer does not match and you don't believe that 401k is an investment pool right now, would your 401k investment strategy be different than a brokerage account? That's the question was posed.
Okay, so the question is like, if your employer doesn't match, like, is it worth it to still do the 401k? I would say that it is, because the match is great. We would all love if our employers matched, but if you're an employer and they don't match, you should still consider doing it, because the purpose is to get the tax deferred, the tax advantages associated with it. So the money you put in is tax deductible basically, and then it grows tax-free for all the years that it's in there. You don't pay tax until way later when you withdraw. So you still got all those tax benefits. So just if, if they don't match, they don't match, but I would still consider doing it.
I agree. Yes. A match is a minimum number that you're targeting. So without a match, still be contributing. Nothing's going to beat that tax-free growth.
Understood. And Stephanie, talking about taxes, had a fun question in the chat for you. Is it still possible to overpay taxes and then use the tax refund to fund an IRA? Is that possible?
Also overpay your taxes, and I'm reading this question, and use the refund to fund an IRA. I don't fully understand that. Like, you're paying a lot throughout the year and then you're getting the money back and putting it into an IRA. I don't think the timing of that works out, nor have I heard of anyone like doing that. Michelle, you can jump in. I don't know.
Michelle?
I mean, it would have to be, as far as timing, yeah, it would have to be like a really early refund to like get it in.
Yeah, because you have to get that in before April 15th. So I don't know that would work.
Unless it's just, I mean, from a budgeting perspective, I certainly know people who just would rather like, just take the taxes from me, please. I don't want the money in my hands. And then when I get it back at the end, I have this budget that like is kind of found money. So maybe it's like, I don't have to think about contributing, but it did kind of sound like the timing mattered.
I've never heard of this. I like to think I know a lot about different like random, we'll call it schemes. I know it's not a scheme, but that's one I have not heard of.
This is again from the question poser. Someone told them that you could backdoor adding to a Roth by again overpaying taxes. So again, we'll have to follow.
Backdoor Roths are a thing. Michelle talked about that. I don't think this is the exact same thing they're talking about.
Understood. Well, we can move on to the next question.
I get it. And like I get the theory, but I would not run with that. No.
Yeah, not run with that is loud and clear. So let's talk about folks at different stages in their careers. Maybe folks, again, I had a couple questions for people who maybe don't work for large corporates or brands, companies, et cetera. What if you're an early career freelancer? What if you own an LLC? What are the options for investing or these personal financial practices instead of employer plans? Michelle, how about you start with this?
Happy to. So IRAs can be opened by anyone as long as you have income for the year. You have to have as much income shown on a tax return as you are planning to contribute to the IRA. So if you're going to contribute your full $6,500, you have to be showing $6,500 in taxable income on your return, period. So they don't care if you're saying, yes, I made $6,500 and I'm contributing all of it to our retirement account. They don't care, but you have to have earned it. Part one. Solo practitioners, LLC owners, etc. When you're self-employed, there's a kind of IRA called a SEP IRA. It stands for brace yourself, self-employed pension. And those have slightly higher contribution limits because they know that you don't have a 401k and you don't want to be confined to an IRA. Those, I mean, it's a calculation to run with your tax advisor. I'm sure there is a do-it-yourself calculator online somewhere where it will tell you kind of roughly if you're making this much, it makes more sense to do it this way. But you get to go up to not 53,000 anymore, I'm sure, a year. But
66.
wow.
Yeah. 66 is the 66,000 is the max you could put in a SEP IRA, but it is based on your income.
Those COLA adjustments are finally catching up. So you can put 66,000 up to 60,000 as long as you've earned it on paper into an IRA form. So it's much more like an IRA than a 401k. You get a lot more flexibility in investments, et cetera, but as a self-employed person.
Got it. And Stephanie, anything to add? I had a follow-up question now. Someone in the chat put, if my employer offers both a Roth and traditional 401k, should I focus on Roth? Should I do traditional or both? Assuming, let's say this person is early career, but making a relatively high income, let's say then, anywhere 95,000 plus maybe.
Okay. So, well, let me just answer a little bit more of the previous question about the freelance self-employed. Because you can do the SEP IRA. You can also, just so people know, you can also open what's called like a solo 401k, which is basically like you have a 401k at a company, except it's your company and you are both the employee and the employer. So you can make contributions in that way. If you're someone who's self-employed or freelance, most likely you have an accountant, and your accountant, you should just like run this by them. Which one should I open? How much can I contribute? Definitely with the SEP, they are going to tell you how much you can contribute. You're not going to be able to figure that out yourself. Your accountant has to run like a specific formula, and they're going to tell you it's 13,000, whatever the amount is. So if anyone's freelance or self-employed, those are options for you. The traditional versus Roth question. So the question is like, which one should someone do? How do you know? So I think it's an art, not a science. Typically, I think if you're earlier in your career, if you are in a lower tax bracket, I like to do the Roth. I think the Roth makes more sense. Pay the tax now while you're in the lower tax bracket and know that you're going to take it out tax-free later. If you are getting paid a lot right now and you're living in like New York City, it's a high tax city, high tax state, you're in a high income tax bracket, then you probably do the traditional because you kind of want your tax deduction now. So that can be how you figure it out. And know that at least right now, if you are getting an employer match, the employer match right now also goes in as pre-tax. So you can do Roth, your employer is going to put it in as the match is pre-tax, and you sort of have both.
Understood. Thank you again for both of those responses, Stephanie. I'm going to move on to some more questions, and Michelle, I'll give this one next to you. Speaking of Roth, how about setting up Roth IRAs for teenage kids? So I guess this is someone with teenage kids. Is this something that parents should be doing? Parent who might own a business, if that makes a difference in the answer. If so, is there like a max that people can contribute to these Roth IRAs they're setting up for teenage kids?
So owning a business is a helpful detail because just like a fully grown human, teenagers also have to show that income for the year on a tax return. So your kids do have tax returns. Technically, they're your tax returns. And if your kid is babysitting is always the example, or walking dogs, or selling lemonade. You should theoretically be reporting it. If it's substantial, if it's significant income, you should be reporting it on your tax return as part of yours. Not giving tax advice. And if you own your own business and you can document that your children are making $6,500 a year, cool, yeah, contribute $6,500 a year into a Roth IRA for them. That is a wonderful and generous thing to do. Remember to invest it. It is going to be post-tax dollars. They are teenagers. Like, it is going to have to show up as income to be eligible to be put into a Roth.
Stephanie, I'll turn to you. Thanks, Michelle, for that. Anything to add?
You can definitely do this if your child is not, like, if you're not a business owner, your child doesn't work in a business. If they're like a lifeguard and they made $2,000 for the summer, you can put $2,000 into a Roth for them. It doesn't have to be like from the dollars they earned. So you can say to them, okay, you know, you made this money, like, I'll match it, I'll put this in a Roth for you. So that's definitely doable if that's how you want to fund something for them. You know, there's 529s if you're trying to pay for college. It's like a college savings account. So if you want to do something kind of extra, you could do the Roth.
Understood. Thank you both. Okay. So one last audience question for this segment, and then we're going to talk about different types of insurance in a couple minutes. I know we received a question in the chat and the Q&A as well. So just bear with us for this last question and we'll pivot topics. But again, I'll start with you, Stephanie. Is there such thing as a fee-based investment advisor versus a fee-based financial planner? Is there a difference there? Are they the same thing?
I would say those are the same thing. I mean, fee-based is a term, and that's basically means that you, for your business, you know, the way you're compensated is via a fee, whether that's based on the assets you manage for that person, whether it's a flat fee, whether it's an hourly fee. It basically just means that you're not, you know, you're not really paid through like commissions, which is what we talked about before, which is when like someone buys a product from you and you're paid. So fee-based is a good term. Investment advisor, planner, those aren't like very regulated terms. So you'll see both of those.
Great, thank you. Okay, so Stephanie, just to stick with you, we're going to pivot now to insurance, and let's start with life insurance. Can you talk about the various types of life insurance? And I had a question also for you in the follow-up chat after that. So let me let you speak on it just at a high level.
Sure. So high level, there are two broad types of life insurance. So there's something called term insurance, and that is insurance that you have for a term, a period of time. It could be 10 years, 20 years, or 30 years. You pay for the insurance and then it expires at the end of the term. And then there's something called permanent, and permanent is basically life insurance that does not expire. It stays with you for your whole life. There are various names for this. It could be called, and they're all a little different, but you can, whole life is one type, universal life, variable life. Those are all kind of under the umbrella of permanent life insurance. I'm a big proponent of term insurance. So that's the one where you're paying the premium every year to the insurance company, and then after the term is up, you stop paying, and then you also stop having insurance. So it's commonly said that this is like renting insurance because it's just for a period of time, right? Like you buy 30-year term, you use it, you pay for 30 years, you have 30 years where you're covered, and then it all ends. The natural inclination that people will say is, why would I put all this money into something and I get nothing out of it? Isn't it better to put money into a permanent policy and I keep it forever? So those are like the common questions. And I would tell you that first, you are getting something out of the insurance, which is that you're insured. Home insurance works the same way, right? Like you pay for home insurance every year and you hope your home doesn't collapse. Like that's not the goal. The goal, you know, you hope you never have to use your home insurance in that way. You hope you never have to use your life insurance in that way. Second, the reason myself, many other financial planners dislike permanent insurance is because permanent insurance is very expensive. It is many times the cost of term. So to give you context, this just happened on Monday. I was looking at someone's insurance they brought to me. They had $1 million worth of term insurance, and that was costing him $1,500 a year. He also had a permanent policy that was $15,000 a year. So that's 10 times the cost for the permanent insurance. So I would much rather you pay like the $1,500 a year for the term, and you could take your remaining $13,500 and you can put that in your 401k, or you can put that in your own investment account and not put that, into like an insurance policy.
Makes tremendous sense from a cost perspective and investment perspective. Thank you so much, Stephanie. Let me actually go to Michelle for a follow-up, talking about, how should I think about life insurance? And we received a question in the Q&A, when or how much does life insurance, make sense? Like when does it make sense? How much does life insurance make sense? And also long-term care insurance, if we can delve into that a little bit, Michelle, that'd be great.
Love to. I was nodding away while Stephanie was talking about term insurance and the purpose of it. Because the purpose of life insurance broadly for most people, like 99% of people, is not to like create millionaires out of family and friends when you're gone. It's to replace income and create a cushion for the person or the people who will be left behind. Because in all of these scenarios, like, your debt is an important thing to keep in mind, and people forget. If there's a big expense that you're worried about, like a mortgage, and that's a big thing in my day-to-day, like if you're getting a new 30-year mortgage, let's just like see how cheap, not how expensive, let's see how cheap 30-year term is to just cover the entire value of your house. Because everyone who's on the mortgage should get one. It's probably going to all in cost less than $5,000 a year. And if a piano falls out of the sky and you are gone, the other person can pay off the mortgage if they want to and be done, or set it aside in a savings account and just know that they have funds to pay the mortgage, and it's one less thing on their shoulders. Because you're gone in this scenario and they're upset about it. Mortgages, future college costs. A lot of people, when they have their first child and maybe second child, every time they have a kid, they decide, let's do 20-year term for whatever the total amount might be of college in 20 years, so that if anything happens before our kid is reasonably expected to be through college, we know they're covered. Those are good times to think about term insurance, just to meet those goals immediately should something happen to you during the time that you were planning to save for them. When I said for most people, there are people for whom whole life insurance does make more sense. There are ways to like insure multiple lives, 2 lives, where it's second to die insurance, and that can be more of a plan for like a whole family, and then it does make sense. There are times that it might be part of a gifting strategy, it might be part of a compensation strategy, but those are higher level things where an advisor and an accountant would probably be very involved in that discussion. Long-term care insurance. I love long-term care insurance. It takes a few forms. Traditional long-term care insurance is a lot like health insurance. You pay monthly or annually, and you are covered for a certain amount of long-term care. And long-term care is care that you need either in the home or in a facility because you cannot complete what is called 2 of the 6 acts of daily living. It's like feeding yourself, clothing yourself, showering, going to the bathroom, stuff like that. Long-term care, traditional, is not as common anymore, just because, like Stephanie mentioned earlier, people don't like totally get the idea of paying off into the abyss and like, what do I get? How do I know? Do I remember? People don't remember they have it. There are also policies that are exclusively long-term care policies where you can put a lump sum of money, like starting with $25,000, which is kind of reasonable, over a period of time, and you buy a certain dollar amount of long-term care for your life, and you kind of dribble it down, and at the end of your life, if you haven't used it, you get that money back, maybe plus a little extra. You can also, third one, buy life insurance with what's called a long-term care rider. It's very granular. And you then have to qualify both for life insurance and for long-term care insurance, different kinds of qualifications, an interesting thing to think about. But then you have life insurance of $500,000. And should you need long-term care insurance before you need the life insurance to kick in, you can draw down on that $500,000 value until it's gone, or until you pass away, and then the remainder is your death benefit. Did that cover it?
Yes, very thoroughly. And, we got a question also as a quick follow-up, talking about employer provided life insurance through work, So this is asking, well, one, I'll ask you, is life insurance through work enough? 2, how does it, work as far as portability? Meaning, is it just as active while you're employed at that particular employer, or could you carry it over to a new employer?
I love the portability question. Nobody asks the portability question. That's going to vary by employer and really by policy. So always, I mean, don't ask HR in like a way that makes them think you're going to quit tomorrow. But you can always ask your benefits provider, like, hey, is this plan policy portable? Because usually when employers are buying group insurance, they're getting some kind of discount for it. That's why they can provide life insurance to so many people as a benefit. Yes, we pay for it, but it's still steeply discounted. So the trend is it's less portable. Sometimes for like higher level executives, it becomes a little more portable, but you always want to ask. It does not hurt to ask. And then is employer insurance enough? It depends. Most employers will offer kind of a range that's on the low, centered-ish on 1 times your annual pay, but there's a huge range throughout the market. If you're assuming that the goal is to provide for those loved ones that are left behind and they're really upset that you're gone, is that enough to like replace your contributions for a year? And their contributions like to a household, to the people who are maybe not able to work or provide for themselves in your absence, because you're looking to kind of give them time to get themselves together, not, create those baby millionaires that we talked about.
Many thanks. All right. Well, conscious of time, we're at 7:59. I want to thank you, Michelle and Stephanie, for your time and your energy and your real wisdom from 2 expert financial gurus that we're lucky to call fellow ILREs. So thank you so much. It was a pleasure and a privilege to be educated by you tonight. Hope that we can continue to follow up post this event and reach out to folks that we couldn't quite get to their questions. But now to wrap with the final minute, I will turn it over to the ILRAA President, Nicole Mormillo.
Thanks, Mike. And I echo your sentiments towards Stephanie and Michelle. We are so grateful for your time and talent. This was a really educational and substantively valuable program, and I hope that everybody got as much out of it as I did. As Mike said at the outset, the ILR Alumni Association is a group of alum. You're automatically in when you graduate, and we're focused on contributing time and expertise to really support each other in our connections with the school, students, faculty, and the alumni community at Broad. Events like this make the association really shine. We can share our time and expertise with each other and benefit each other. I want to make a plug for some upcoming events. We have a second session of financial literacy on November 1st, covering home buying, mortgages, budgeting, education planning, and diversification. We're going to, delve a little deeper into some of these topics and cover some new topics. Mike will be back. He was a fantastic moderator. He'll be back for session 2. And then we have some welcome to the region alumni receptions coming up. We'll be in New York City at Schnippers on November 2nd, in DC at the Admiral on November 7th, in Westchester on November 15th in White Plains, and we have a Cornell versus UPenn football tailgate coming up. This is just a taste of some of the events. We have much more ahead. Please feel free to reach out to me. I put my email in the chat, but it's N for Nicole and my last name, MORMILO @gmail. If you want to chat or if you have ideas about event programming. Thanks again to everyone who joined, and thanks again to our speakers and our moderator. Have a great night, everybody.